is a beautiful May lunchtime here in the north of Scotland, and given that I've got two teenage lads in my house, you don't really get very much peace and quiet at all on a weekend, and hence why I've decided to come out and about again to another beautiful location, slightly different again, and I feel very much like I'm giving people a walking tour of North Scotland every time I do one of these videos now, but it seems to be going down really well, so we'll keep doing that. Last week I spoke at quite considerable length, I think over a couple of videos and two articles as well, quite heavily about investments and what was going on in the investment space, particularly with respect to the stock market, the cryptocurrency market, and the broader macroeconomic factors that were perhaps influencing what was going on there, and more importantly what we should expect over the coming weeks and months as we go towards the back end of the year. And I can't believe it, certainly, that we're nearly halfway through already, and I just cannot believe that the time has gone as quickly as it has. But we digress. Today I wanted to go back a little bit and talk more about personal finance, because that's something that's clearly very important to everybody. We've all got our own financial lives, as it were, and there are a few things that are falling out of recent macroeconomic events that I think are going to make a really big impact to people, especially homeowners. And what we're going to talk a bit about today is mortgage rates and maybe things that we can do to help lower our mortgage payments in an environment whereby interest rates are potentially going to be much higher for people. So for context then, if you bought a house anytime really before 2022, you would have enjoyed quite a lengthy period of time whereby your mortgage rates were relatively low. Now, the housing market is a really strange beast, and I've written about it before, and I would commend those articles to you, in the sense that, yes, of course, supply and demand is something that's really important for figuring out house prices, but it's not just the supply and demand of the houses that is important. It's also about the supply and demand and the cost of the money. So before I talk about what's happening today, I'm just going to go back and paint a bit of a historical picture. And before I do that, a real health warning. When I start to talk about how housing was perhaps in the 80s, 90s, that is absolutely not meant as a one-upmanship game, if you like, between people that are buying houses and paying mortgages today versus people that bought them 30, 40 years ago. I completely recognise that people worked incredibly hard 30, 40 years ago, or whenever it was that you bought your property, to pay your bills, keep on top of your mortgage and get ahead. And I'm not taking away from that at all. I think the point that I'm trying to make before I start this explanation is that the macroeconomic climate is different, and therefore we have to approach the problem with a different mindset compared to what we did 20, 30, 40 years ago, where those rules that applied then do not apply today. So if you go back to the 1980s in particular, interest rates were really quite high compared to what they are now, and there'll be people perhaps watching this or pick this up later that would say that they were perhaps paying even double-digit mortgage interest rates when they bought their property, and for probably quite an extended period of time as well. And that's really interesting, isn't it? Because over the last 20 years or so, certainly since the 2008 crash and in and around the Blair years, again, I'm not trying to finger point at any particular government, but roughly the mid-2000s onwards, we've seen those interest rates fall really, really drastically. And we're now at a point, or not now, but certainly between roughly 2008 and 2021, where money was as close to free to borrow it as it ever really has been. And my own personal theory is that, as well as a supply problem because of ageing populations, the correlation of ageing populations, higher net migration, and really cheap money, and a shortage of housing construction relative to population growth, has pushed the prices up and up and up. So yes, mortgage rates are much lower than they were historically, and by historically I'm talking pre-2005-ish, but the house prices themselves are much, much higher as well. And certainly if you look in some other markets, particularly down south, you will see that actually there's been a slight correction in housing prices because people are not in the position where they can pay the asking prices. And certainly if you were on X, there was I think it was about a week or two ago now, really quite a popular article that did the rounds by one of the papers, and it went pretty viral. With the respect that there was a lady who bought her property. Whenever she bought it, it was now worth about £800,000, and she felt trapped because she couldn't sell it. Now, a debate about could you not sell it versus could you not sell it and get the price that you wanted is perhaps a different question, but I'll leave that with you to ponder. So the point I'm making then is, since the 1980s, 1990s, interest rates have broadly trended down, but the housing costs have trended upwards. Direct correlation there, really. There's a graph that I made a few weeks ago. I'll drop that in the chat so you can have a look, tell me what you think. And we're now at a point where people who bought their properties, particularly those people that remortgaged around the year 2021 on those longer fixed rate mortgages, which was a really sensible thing to do, by the way, if you were in that position, because you were getting a really cheap mortgage relative to the price of the property, and now reaching a point where those fixed rates are coming to an end, and they're moving on to the variable rate of whatever it is that their mortgage company is lending them. But clearly, because of the macroeconomic conditions since 2021, 2022, the interest rates are much, much higher. And although people are in theory living in the same house and they have the same mortgage, in the respect that the amount that they've borrowed has not changed, they are being asked to pay a significant amount more for an extended period of time, probably for the rest of their mortgage, to be really honest with you, than they have probably ever before if they bought it in the last 15, 20 years or so. Which I guess begs the question, if you are one of those people, what can you do about it? And you might be one of those homeowners that feels quite trapped. You've maybe already got into those remortgaging negotiations, because you can start to do that roughly 6 months out, penalty free, from when your current rate expires, and saying, oh my God, I was originally paying this, I'm now being asked to pay that. That's a massive stretch on a household budget that has already been stretched quite significantly for a number of years, and I'm really not sure what I'm supposed to do about it. So I'm going to just unpack now a few simple strategies that you might want to think about. They won't necessarily work for everybody, and again, a real health warning with anything with respect to personal finance. There is no such thing as a free lunch, and I can't sit here to you now and say, oh, well, if you just do A, B, and C, as you know, as easy as done as said, everything will be fine, and you'll in fact make a saving on your mortgage. You probably won't. And the reality that people are a bit afraid to talk about in some circles is that this might be a bit of a damage limitation exercise for the vast majority of people. But look, I'll go through it. If you've got any questions, stick them in the chat, and I'll be glad to try and pick them up if I can. Number one, shop around for your mortgage. Certainly what I'll be doing when my mortgage comes to renew in about 18 months' time, I'll be looking for a mortgage broker. A mortgage broker is an independent person. They are a professional, they are regulated, and they have the ability to look across a large part of the mortgage market and help find you the most competitive deal possible. Some charge a fee, some don't, and it's always worth having a conversation about that with your broker so that you understand the cost that you're being asked to pay. But certainly when I bought my property, used a broker. She was a local independent firm, really nice lady, and I will probably never not use a broker again for my mortgage and insurance products. That doesn't work for everybody, but certainly if you're someone that is less financially savvy, I cannot implore you enough to seek independent advice from someone who, as a broker, has a professional responsibility to you to get you the best possible deal. Don't underestimate that value. Interestingly, a lot of people will tend to stick with the same bank or the same mortgage lender for the entirety of the mortgage without realising that they're massively overpaying on what they could have done if they'd have just shopped around. And actually, even if the mortgage broker charges you a couple of £100 for the work that they do for you, you could potentially save that in 1 month's mortgage payment, and by month two it's paid for itself. So something to really worth thinking about. Get a mortgage broker, number one. Number two, try and get your property into the best possible loan to value band. what do I mean by that then? So let's just run a fictional example. Let's say I go out and I buy a house for £100,000, which would be a great deal in today's climate for most people, by the way, but it just helps give a nice round number to work with. I buy it for £100,000 and I put a £10,000 deposit down, and the mortgage lender puts the other £90,000 in to make the 100,000. I then therefore have a 90% loan to value. I owe 90% of the value of the property still as a mortgage. Okay, now when a bank lends money for a mortgage, the most important things it's thinking about are risk and return. How risky are you as a potential customer, i.e. are you going to pay the money, and B, what is my likelihood of getting that money back in the way that I have forecasted it when we made the mortgage offer. Now clearly the higher the percentage of the loan to value on the property, so in this particular case 90%, you can sometimes get mortgages at 95% loan to value, but there's not many, but there are some out there. It's a higher risk to the bank, because if you stop paying, they have a lot more money outstanding than someone who has potentially put down a much bigger deposit or has owned their property for a long time and is towards the back end of their mortgage deal and is now maybe at only 10-20% loan to value. Because in that fictitious example, if I had a 20% loan to value, I would only be owing the mortgage lender £20,000 of cash against a £100,000 house versus £90,000 for the same property. Interestingly then, if in the and it does sometimes happen, and I wouldn't wish it on anybody, I'm sure it's an awful experience, and I have helped people in this circumstance before, a bank has foreclosed on the mortgage. Essentially, we've got into a position whereby, unfortunately, the borrower can't pay for whatever reason. That goes on and on for a period of time, and eventually the bank gets a court order to take custody of the property and sell it on and cut their losses. And you as the owner, you're not the real owner until you've paid the mortgage off, but that's by the by, gets kicked out. The bank takes custody of the property, sell it on. Those houses, or those properties rather, typically sell at auction, and in the vast majority of cases, banks would see a measure of success at around 75% of market value, because when they're auctioning it off, they're not selling it to you or I necessarily as someone that wants to go and move into that property. They're selling it to investors, and others that have got a commercial interest potentially, and are just not going to want to pay market price. So in reality, if they get 75% of the actual market value, they've had a good deal. And in the context of a buy-to-let mortgage then, not a buy-to-let mortgage, in the context of your mortgage and loan-to-value, what that means is that as you start to come down those loan-to-value brackets, the perceived risk of lending to you is lower, and therefore it opens up potentially better rates that could be anything from £50 a month upwards in savings from being in this loan-to-value band versus being in that loan-to-value band, even though they could be the next ones, and I'm going to make something up now, the 80% to the 90% or the 85% to the 90% could potentially be a really, really big difference. So the second thing is get yourself in a lower loan-to-value band. How do you do that? Multiple ways, but I think there's two options that I want to float out to you, and that is, first of all, can you overpay your mortgage? So for anyone that doesn't know, when you take out a mortgage deal, the lender typically front loads the mortgage payment. And what do I mean by that? Let's assume that your mortgage payment is, for the sake of easy maths again, £1,000 a month. You might find that in the first few years of your mortgage, £700, £800, £900 of that mortgage payment is actually interest. Only a tiny percentage of it, relatively, is going towards the principal, and the principal is the amount that you actually borrowed to buy the house. As you go through the mortgage deal, the amount of interest that you pay per payment goes down and the amount of principal goes up. Eventually it flips, and towards the back end of the mortgage, you're paying far more principal and far less interest. Is it moral? Probably not, but hey, that's how the deals are structured, and beggars can't be choosers. If you're going to buy a mortgage and it's legal to do it, then you're going to borrow on the lender's terms, right? But the point I'm making is that, especially if you're early into your mortgage payment life, you're going to still owe quite a lot of principal. And if you can make an overpayment on that mortgage, that overpayment doesn't go towards the interest. It almost always goes towards the principal. And that means you're going to start chipping away at, when we go back to our fictional example, that £100,000, so that you can get it down, the amount you owe, you can get down much, much faster. And what that can do is it can then drop you into the next loan-to-value band. Now, most mortgages typically have an overpayment rule, so most will allow you to overpay, but they'll only allow you to overpay a percentage of your mortgage each year without a penalty, 10%, for example. So you could make a small overpayment, and even a small overpayment, if you can afford to do it, will make a really big difference on your mortgage. Or alternatively, when you get into that 6-month remortgaging window, you go to remortgage the property. At that point, again, speak to your broker, you are typically allowed to put down as much capital as you like against the mortgage. So although there is a limit during the mortgage for overpaying, when you come to do the remortgage with a new lender, you can put more cash towards that. If you, I don't know, maybe you've inherited some money, or you've come into a lump sum, you could put all of that down at the remortgage point, and it would then take you into the next loan to value band, or potentially below. So that's one way to do it. The other way to do it, and you might choose to do this particular technique in tandem, is to get the property revalued. So typically, and historically at least anyway, property prices have trended upwards over the last 10-20 years or so. So firstly, when you bought the property, let's assume you bought it in 2010-ish, 15-16 years ago, there is a reasonable chance that your house, even if you did nothing to it bar look after routine wear and tear, is probably worth more than what it was when you actually bought the thing 15-16 years ago. And therefore your current mortgage might be calculated against an older valuation, particularly if you've been with the same mortgage provider for a very long time. And so by having the property revalued, the property might go from being originally worth £100,000 with £75,000 owed on it to worth £140,000 with £75,000 on it. And all of a sudden, that makes a massive difference to the loan to value of the property. That will multiply itself even more if you've done a lot of renovation, decorating, and it's in a particularly attractive area. But you know, if you've done work to the property and you know that that's going to add value, and especially if you bought it a while ago and you can't remember the last time you had it valued, speak to the broker about getting a valuation on that property, because it's going to make a massive difference to the loan to value band. So if you can do that, that potentially costs you nothing, or a one-off fee for the valuation itself. It can make a big difference. But if you can do both that and pay down the principal, either in smaller increments or through individual lump sums, when you come to remortgage, you're hopefully going to be in a much, much better place. Like I say, that is not the most comprehensive guide that's out there, and for a lot of people, they might still be able to do all that and still not be able to get the mortgage down to a level that they want to do it. And that's a real challenge, and I won't pretend it's not, especially for those people that have bought properties and planned their finances around what's been a relatively stable mortgage payment for a long time, but are now having to think about whether they're going to find an extra few £100s in the month to cover that mortgage bill. But I hope that is something that is of some use to those people that are out there and thinking about that. Really important to remember, even though interest rates have generally trended downwards, that they were held recently by the Bank of England, mortgage lenders move their mortgages they don't really sync to what the Bank of England is doing that tightly. But the Bank of England base rate is a really good guide. And like I say, it has come down over this last year or so. But let's call a spade, and it's significantly higher than what it was. And even though it has trended down, if you're someone that bought or certainly fixed at the back end of 2021, you're going to be in for a pretty raw deal when that mortgage principal comes up, or that mortgage comes up for renewal rather. So that's mortgages. Second part that I want to talk about then today is with respect to just some of my reflections on the week, and I wanted to talk about, interestingly, professional advice or support, and by that I'm talking about either a financial advisor or a coach type person, versus using things like artificial intelligence as a means of supporting you in your personal finance journey. And the reason that this stuck with me a little bit is because I got into quite I won't call it a heated exchange, but there was certainly some strong opinions exchanged by some people on Facebook, whereby I follow a number of groups for a professional interest, clearly, and there was somebody that put something out there. They were in a bit of financial difficulty, didn't really know what to do about it. Any advice, please? Kind of post into this group. Those groups can be really helpful, right? But they're also a massive double-edged sword because people are usually quite quick to hide behind a keyboard and offer out financial advice that's not financial advice and seldom takes account of the broader situation around that person. But also, you can only guide people based on what you tell them. And frankly, if people are given a pretty poor explanation, not because they're stupid, but they might be in distress, they might not be very articulate in that respect, they're going to get some really poor answers. And this particular person's situation was quite complex. So I jumped on and said, hey, look, based off what you told me, it sounds like X, Y, and Z might be worth exploring. But also it sounds like your circumstances are quite complex, and I wonder if you would benefit from sitting down with somebody that can perhaps help you some more on a one-to-one basis. And not so much for me to do it because, I don't think I was the right person to support that particular individual because of the nature of their issue. But there'll be somebody out there that was, and I think that's the point that I was making. Cue then the army of keyboard warriors all jumping on there saying, well, why don't you just put it all into Claude or Ask ChatGPT and all this other stuff. And to be fair, it's a really valid point, because anyone that's relatively savvy with this stuff can get lots of useful information at their fingertips really, really quickly. But it's also quite a flawed system in the same way that somebody putting a Facebook post out is a flawed system, isn't it? In the sense that you could go into Grok, that's the one I use at the moment, which is a really, really good tool. But if you give it a crap explanation, you're going to get a rubbish answer, first of all. Second of all is, if you're someone that is perhaps, and I hope I don't sound rude when I say this, at a lower end of financial competence, it's not always obvious when the machine has perhaps misunderstood what it is that you're asking it, or has presented you with either incorrect or outdated information. That's the second point. So again, you might not give it a great explanation. You might get facts back out of it that you don't realise are incorrect, but hey, the machine told you, so it's got to be right, and I'm going to now do stuff based on that. So that's the first part. The second part, of course, is that there's a human aspect to this as well. I'm a huge believer that personal finance is exactly that. It's personal, and we in the UK don't talk about our money very much, and that's just what we do. But I think there is something to be said sometimes for swallowing your pride, recognising that you do need a bit of support, and sitting down with someone who is going to act in a professional, non-judgmental way and can help you through that problem, whatever it is. And sometimes you don't need a machine to spout facts at you. You need someone to sit down and say, hey, I've actually been in your situation, or I've supported people that are in your situation. Here are some things that typically work quite well. It's going to be okay. Let's work through this together. And they might even go and use AI to find the most up-to-date information about whatever it is that they need to work on. But the point that I'm making is that is someone who, first of all, can spot the red herrings, can ask the right questions, but can also have a proper conversation with that person to extract the information that they need and develop a more comprehensive understanding of that person and their circumstances. So a real mixed week for me this week. I'd be really interested for anyone that's willing to jump on the comments to hear your thoughts about the whole AI in personal finance chat. I think it's a great tool. It's clearly here to stay, and there's lots of things that you can do with it, but you've got to make sure that you understand what it is that you're telling it, what you're asking it, and that you can really scrutinise the information that's coming back your way. Hopefully next week we're going to look at a little bit more personal finance based stuff, and I'll write a couple of articles up during the week about what we've discussed today on the video for those of you that have joined us a little bit later. First part was all about mortgages. Very quick canter through that. There's a lot of people who bought property a while ago. They've been sat on cheap mortgages for a long time. Most 5-year fixes are now coming to an end that were the cheapest of the 5-year fixes, because 2021 was the last year really that on large scale we saw cheap credit like we've historically seen, and people are going to get a real shock when those remortgage bills come in. And the tips that we chucked out there were, first of all, don't just stick blindly with the same product and the same lender. At the very least, and I'm adding a little bit here now, if you don't want to go down the whole remortgage process, look at a product transfer, i.e. ask that lender to give you their best possible deal that's currently on the market, and they typically will. It's quite straightforward to do. It's a lot easier than simply remortgaging. Number two, if you can, remortgage through a broker. That's an independent person who has a professional responsibility to you. Some charge a fee, some don't. Ask about that. Who can search the vast majority of the mortgage market and find the best possible deal for you and your circumstances, and can perhaps guide you on what product might work better versus not. And the second one is, when you do come to remortgage, do everything you possibly can to get your property in the lowest possible loan-to-value band, whether that's overpaying a little bit of the principal each month. In that 6-month remortgage window, put down a lump sum when you do the remortgage to knock yourself down into the next loan-to-value band or beneath it. And thirdly, especially if you've done a lot of work to the property, or you've owned it for a very long time and you've been with the same mortgage lender, get a valuation, because you might find that your property is worth significantly more than what it was, and that's going to make it a much more attractive prospect for someone that is looking to lend to you. None of those are silver bullets. The vast majority of what I've just said to you is damage limitation, but I think that it's so important that people recognise the reality. There are too many folk out there at the moment, especially in the content creation space online, that will just make it all sound so simple and so easy. There is a very famous celebrity who went pretty viral this week. He's an American business star. I won't name names, but essentially said, hey, well, if you earn $60,000 a year or whatever it was, and save 20% of that, within however many years you'll be a millionaire. Well, duh. If I save £1 million or invest an enormous amount of money, of course I'll be a millionaire. But life's not as simple as that. This is about understanding the products and how that's going to interact with your real life. You might not be able to do anything that I've just said, and I completely recognise that. If you're in that space, it's a different conversation again, thinking about what you can do to find or put an extra few £100s a month into your monthly budget so that you can pay those mortgage payments and sustain a standard of living. Second part of that, of course, was just a little bit of personal reflection on some of the things I've encountered online with respect to the role of artificial intelligence and supporting people through personal finances. I'm a massive advocate of the stuff. It's here to stay, but take it with a pinch of salt, scrutinise what it's saying to you, and it's only as good as the information that you give it. Sometimes there is just no substitute for sitting down with a real person who can walk in your shoes with you to get to where you need to be. Hope you enjoyed that and hope you found it useful. Please share it to anyone that you think might benefit from some of the stuff that we spoke about, particularly with respect to the mortgages. And I'll drop those charts in the chat when I get home later this afternoon, so that you can have a look and compare the correlation between historic interest rates, housing prices, and you'll be surprised to see that there's actually quite a tight correlation. Have a great weekend, and I'll look forward to speaking to you again soon. Take care.